Hello and welcome everyone to our podcast series Money Matters on money, banking and central banking by the Institute of International Monetary Research. The purpose of the Institute is to demonstrate and bring to public attention the strong relationship between the quantity of money on the one hand and the levels of national income and inflation on the other. I am Damian Pudner, Director of the Institute, and today my guest is renowned economist, author and blogger on banking and the financial system, Francis Coppola. Francis, welcome. It's a real pleasure to have you with us today.
Hello there.
Hi. Francis, many of our listeners will know you, of course, from your strong presence on social media and appearances on TV, but also from your 2019 book, The Case for People's Quantitative Easing, when you argued that the new central bank money went to the wrong people. Basically, the rich got richer and large companies and banks also benefited, whereas those that really needed it the most didn't get to see much. So, thinking about QE, how would you evaluate the Bank of England's immediate response to the COVID-19 pandemic in 2020?
Well, in a way, it was a bit like their response to the 2008 financial crisis, that the initial response, which was massive QE to prevent markets melting down and asset prices going into a dangerous downward spiral, was appropriate and it worked. But then after that, they continued with QE when they didn't need to.
Right. I mean, you've been highly critical, obviously, in your initial book from 2009 and QE then, that the Bank of England has basically created this huge inequality. I mean, they've just done it again, haven't they?
Yes, they have. One of the things we saw during the COVID years was a vast increase in asset prices and in savings in the top half of the income distribution, at the same time as people in the bottom half of the income distribution were actually getting poorer. So it's we could say that that is partly also due to fiscal policy, but Bank of England QE had quite a bit to do with it.
I mean, that's right. I mean, over the last decade and a half, I mean, we've seen a huge rise in house prices and equities, basically off the back of low interest rates, but primarily, I would argue, of all this additional money that the bank has created. I mean, obviously, we're now seeing the reverse of that in monetary policy. We've got monetary policy tools, effectively going the other way. We've got quantitative tightening. We've got higher interest rates. While there's, not a linear relationship between QE and QT or high and low interest rates at different points in time. What do you think is going to happen to asset prices going forward?
Well, clearly, since QE has propped up asset prices over the course of the last nearly 15 years now, I would expect that quantitative tightening done concurrently by central banks around the world would cause asset prices to fall, and really potentially by rather a lot. So much depends upon whether all central banks do this. At the moment, Japan is bucking the trend, and there's
Mm.
also some signs in China that the Chinese central bank is also beginning to loosen. So we might not find they fall as much as they would do if central banks were all doing QT at the same and raising interest rates at the same time. But the Fed takes the lead on this. ECB is important as well. And I would say that certainly for Western countries, I would be looking at a significant fall in asset prices.
Right, right, and I think I'd agree with you on that certainly. I know we have a very different mortgage market to that of the US. We have 30-year fixed rates in the US, and here effectively a fixed rate is maxed out at 5 years. So it is a fixed rate of sorts, but it's a very short term duration trade in that
Yeah.
sense. So
It's
I guess
actually what the Americans call an adjustable rate mortgage. When you say that to an American, they scream and run for the hills because adjustable rate mortgages were so significant in the 2008 financial crisis.
the point is now that with the structure of the UK mortgage market, which has been in place for decades. Of course, it's not a new thing, but basically the change in monetary policy in base rates has an almost immediate effect on mortgage rates.
Well, interestingly, the mortgage structure of the UK mortgage market has in fact changed. Way back, you know, before the financial crisis, if you go back to, say, the early 2000s, you'll see that the majority of mortgages in the UK were actually floating rate mortgages. They were the standard variable rate, or they might be trackers. We didn't, but in the last 10 years or so, really, we've seen the rapid growth of what in the UK are sold as fixed rate mortgages, but as we just discussed, are actually short term teaser rates fixed for 2, 3, maybe 5 years, and then reverting to a floating rate. Now, it's the growth of those really that has changed the transmission of monetary policy. So, whereas way back when um, raising base rates immediately fed through into higher mortgage rates for almost everybody. Now, raising base rates doesn't have that immediate effect on most people. Most people carry on paying what they were before until they reach their reset date. And then, if during that time we've had several increases in interest rates, they get all of those interest rate increases at one go, which it can be a very large increase in their mortgage payments. That's the kind of cliff edge that the people with adjustable rate mortgages in the subprime crisis in America had. They had been paying low interest rates on their teaser rates. When the teaser rates came to an end, interest rates had gone up during that time. And so they suddenly had this enormous increase in their monthly payments. And that's now what a fairly sizable proportion of the UK mortgage market is facing.
That's a very good point. I mean, the data out suggests there's roughly around 2.3, 2.4 million mortgages coming due for reset by the end of next year. So effectively, that cliff edge is yet to hit the property market.
Indeed, and I know the Bank of England is concerned about this because the transmission of monetary policy to the mortgage market is a bit impaired by the existence of these fixed rate deals. Um, it's hard to work out what the impact of monetary policy actually is because they've got like this delayed response. I mean, monetary policy famously has variable lags. It can take quite some time for a change in interest rates to feed through into all corners of the economy and do whatever it do and bring down inflation in the way that it's meant to. But in this case, it is actually a change in the structure of the mortgage market has actually made the lags kind of longer and possibly less variable.
So do you think there's an argument, or do you think politicians will put pressure on the banking sector to change the structure of the mortgage market in the UK, to have these longer dated mortgages, 10,
Well,
15, 20 years? Do you think there's a demand out there for people to lock in the UK that long?
right now, I would say that actually locking into long dated mortgages is the worst thing anybody can do because all the signs are that the economy is softening, and therefore we would expect that we are approaching the end of this tightening cycle. And it may well be that in a year or two, the Bank of England will start cutting interest rates, in which case people would then be locked into interest rates at near their peak for really quite long periods of time, and that's not good. So right now, if you're on a mortgage, the best mortgage to be on is a tracker.
Right. Yeah.
Yeah, or at most a short-term fix. So it's a little bit worrying that people are now worrying about, oh, maybe we should have 15, 20-year mortgages. Well, actually, it's the worst possible time to introduce them. But looking at it kind of in the round, as it were, most developed countries do have longer dated mortgages than the UK. The exceptions are places like Canada and Australia, so forth. But if you look at France or Germany, or of course the United States, then you have much greater use of long-term fixed-rate mortgages. I would have to say, having looked at this, that it's in a way not entirely down to the banking sector.
Right.
Because every single one of them, and of course, very obviously in the case of the United States, have substantial intervention in the mortgage market in order to make it possible for households to essentially transfer their interest rate risk to their lenders without bankrupting the lenders when interest rates rise. Which
Right.
of course happened in the United States with the savings and loan crisis of the 1980s. That's exactly what happened. And it's exactly why now the US mortgage market is dominated by government-sponsored enterprises, which act as mortgage warehouses, buying up the mortgages from the lenders, packaging them up, securitizing them, and selling securities out into the capital markets. And they are ultimately, hence the name government-sponsored enterprises, they are ultimately backstopped by the US government, as indeed we saw in 2008 when both of them were taken into conservatorship.
Right. And of course, we're hearing as well that the UK government is putting pressure on banks to go easy, as it were, on property owners at the moment who are coming up for refixes on their mortgage, to maybe switch to interest only for a period, or
Yes.
So I mean, is that really a good thing? I mean, the whole point is that whether the Bank of England will admit it or not, the whole point is they want people to feel poorer. They want them to spend less money to bring inflation down.
Yeah, absolutely. That is the aim of monetary policy, is for people to feel poorer. I must emphasize here that the reason for this is kind of not that we want people to feel poorer. It's that because of the shocks we've suffered in the last 2 or 3 years, so Brexit, I'm sorry, but it has had this effect, and the COVID and supply chain disruptions as a result of COVID, the weakening of the supply side, and of course the Ukraine war, has had quite a bad effect, really, on the supply side. And so collectively, we are poorer. And
Mm,
what's needed is policies to make sure that hit to our collective standard of living is shared, rather than, if it's not shared out in some way, and that does require policy settings, then it will inevitably hit hardest on those who are least able to bear it, because that's how these shocks work. So when people talk about inflation particularly hurting the poor, that's what people mean.
right.
So part of the objective of what the Bank of England is doing, and also to some extent what the government's trying to do, although there's a little bit of kind of a conflict going on there, which I think we could do without, um, is actually to say this collective negative shock to our standard of living needs to be shared out more
Right.
fairly.
Okay. And I guess that could, I mean, the easier way to do that would be through fiscal policies and a change to taxation at higher rates.
Indeed, and I think in a way we've slightly made a rod for our own backs by insisting that inflation is solely the responsibility of the central bank, when a
Mm.
supply side induced inflation like this arguably needs fiscal policy as well.
Well, that kind of leads nicely on to another question I was going to ask you. I mean, we've had this sharp rise in inflation since 2021. We had CPI in the UK hitting 11.1% in October 2022. It's back down to, what, 6.8% in July. I mean, how much of this do you think can be attributed to central bank policies and the QE in 2020, and how much is to the Ukraine war and the COVID supply chain issues? I mean, can you make a distinction between the two, or is it nothing to do with the Bank of England really? It is all these other external issues.
I think it's a little bit of both. So the proximate causes of the inflation were this COVID supply chain disruption, the Ukraine war, and the UK Brexit, because it does increase barriers to trade. It's making exporting more expensive. It's causing labour market shortages, and that does drive up inflation. So we have to factor all of those in.
Hmm.
But underlying that also is what I said earlier about the excess of savings, particularly in the top half of the income distribution. Now, there is still an awful lot of money in the system, and if you really want the pain to be shared more widely, you've actually got to um, try and clear out the excess money in your system, and
Hmm.
that's what the Bank of England is trying to do. But of course, people resist it because they want to hang on to their savings. They want their wages to increase so that they don't have to feel the pain, so that they don't have to share in that collective shock that has made us all collectively poorer.
Right. And of course, this time around, we had all these policies from the government to help out with the furlough scheme and everything else. That, there was not this, huge demand destruction and job losses that we saw in the global financial crisis. Do you think that's kind of, emboldened people as well at the same time as having this buildup of personal savings, which surely must be, being reduced at quite an aggressive pace, I would have thought now.
Yeah.
Do you think that there's still some way to go on that, or do you think we're kind of getting to the, exhausting what was there and what was built up during the COVID period?
Well, I think we are exhausting. So the reason for that is what I said about it being towards the top end of the income distribution, and the people who are feeling the pain of this least are people at the top end of the income distribution. So there might be quite a strong case for higher taxes on richer people, to try and pull that down a bit faster, as you
Okay.
were saying earlier. But I think that I want to distinguish something here, that the argument in my book was that actually there is a case when you're coming out of a really bad shock like COVID for being profligate with your money supply, because you're going to have supply side weakness, you're going to have some demand weakness as well, and you want to kickstart all that again. So you
Mm,
want to be using helicopter money and other such things, really, to get people spending, so that your supply side has got an incentive to repair itself and to grow and to hire and to do all of those things. And to that end, you might want to run inflation a little bit hot for a while to
right.
allow that to happen. Now, what blindsided, and I'm still saying that would have been the right thing to do, but we had all these other factors as well. We had the Ukraine war, and that
Hmm.
nobody was expecting that. And I would add that we also, in the UK, we also had Brexit, and that is a not a short-term shock. That is a long-term shock to our standards of living.
Right. Right. So, do you think there's an argument for a temporary change in the inflation target to maybe 3% or 4%, or is
Yes,
that a step too far?
no, actually, I think that would be sensible. And I think it's probably what we're going to end up doing,
Hmm.
because, in the end, inflation, central banks can only do so much. If the central bank squashes it too much, then what you end up with, if your inflation needs to be a bit hotter for a while to allow your supply side to repair itself,
Right.
um, then if the central bank stamps on it too much, then you've really removed any possibility for your supply side to repair. I mean, the supply side needs demand. The supply side needs to be able to borrow to invest. There are good reasons actually for not stamping on inflation too heavily if you
Right.
are trying to engender a long-term sustained supply side recovery. And as I said, we've been blindsided on this by the Ukraine war. I must add as well, and this bothers me as well, that for years, for over a decade, we had stagnation of wages,
Mm.
particularly in service sectors, right? And we had over a decade of um, pay caps in the public sector, right, to bring down the deficit.
Yes. Yep.
And all the time we were talking about that, we were saying actually what we really need to be more prosperous as a nation is actually for for our wages to rise. That they've been kept down for too long, and now they're rising. We're going, oh no, we can't have that. It's causing inflation.
Well, I guess the argument there is it's fine to have. I mean, you're right about stagnating wages, and that did need correcting, and that is beginning to happen now. But I guess it also has to be followed by better labour productivity.
Well, not just labour productivity, and I think that one part of the disease of the last decade is actually that people have failed to understand what productivity is. That what we've done is we've driven a lot of people into the workforce who were not there, whose marginal productivity was not as good
Hmm.
as the people who were already there. When you do that, the general quality of your labour force declines, and your labour productivity necessarily falls, and so you end up with, shall we say, a very kind of services oriented economy where nobody's paid very much and nobody's productivity is very high, and that's very much where we ended up after 10 years of those kind of policies. Now we've got the government saying what we want is a high skill, high wage economy. And I look at it and think, well, how exactly are you going to do that when we have seen little in the way of business investment and little in the way of public investment over a long time now. And the key to increasing what we might call total factor productivity as opposed to labour productivity is actually investment.
So this is investment in new technology and all the other things apart from labor, basically.
Investment in all the things that increase our overall productivity rather than the different components of it, if you see what
Right.
I mean. No, I mean, and we have not had a great deal of investment in any of it. And right now, we've got an investment chill because of Brexit. We've got a public sector, which, yes, okay, we had a couple of years of the government saying we're going to invest in all this infrastructure. And now we've got a government that's actually worrying about its fiscal position, saying actually we can't do any of this. And you know, I look at it and think, where is the investment going to come from? And I might add that I'm not the only person who is saying this. I was recently at the press conference for the National Institute of Economic and Social Research's quarterly review. And the director said, of the current political parties, who is going to do the public investment that this country needs? Because actually, neither of the main political parties is really proposing it. He's not talking, and he said he didn't mean by that just infrastructure, but kind of pump priming, whereby the public sector needs to take a lead in order to give the private sector the confidence to come in, if that makes sense.
You know, do we just increase that time over time? Do taxes then have to go up? And then we come back to the question of who bears the brunt of those higher taxes, and and maybe we do need a larger wealth tax, or a new wealth tax, I should say.
I mean, I think we need to sort of rethink, in the light of what kind of economy we actually have and what our challenges are, what we are taxing. And it bothers me hugely. I've looked at all the asset bubbles of the last however many years it is, and lots of, we've had a massive increase in asset prices, and I'm wondering where all the investment went. Well, it went into silly things. It went into cryptocurrency and meme stocks and things like that. A lot of the COVID money went into that. It didn't go into productive investment, and I wonder why. That actually generates kind of good quality, well-paid jobs and things like that. And I wonder why. And it seems to me that we perhaps need to look at that, why it is that capital seems to think it has so few investment opportunities when we have an economy that desperately needs investment. It's very odd that we've ended up there. And it does make me question whether there is a case for saying, well, if the private sector, the capital in the private sector will not invest productively in our economy, then the public sector must do it. And the price for that will be that capital has to be taxed more highly.
Francis, thank you very, very much.
Thank you very much, too.